Well, folks, Opendoor keeps knocking on the door at the $8 price point. We will cover everything we've seen with Opendoor during this Thanksgiving week and where we could be headed next. We will also cover the Stonkcast Watchlist, some other tickers you need to be paying attention to, and we will also break down the latest macro themes, including mortgage rates, which are beginning to drop, and Google, this year's best Magnificent 7 stock, and I will explain why I believe it could have more room to go. All that and much more on this week's Midweek Check-In. As always, if you get value from these videos and you want to help us out with the algorithm, make sure to share with a buddy. Don't forget to like, subscribe, and follow us wherever you listen to podcasts. And now, folks, let's roll. I'm Brandon. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate or a more conservative swing trader or investor, we've got you covered. If you'd like to support the channel beyond liking and subscribing, make sure to check the links in the description. All right, folks, it's time yet again for the Midweek Check-In, and might I add, a very special Midweek Check-In. Happy Thanksgiving to everyone out there. I hope you are full of turkey and watching plenty of football. All right, we got a lot to get into on this holiday trading week. You know, typically the markets are pretty quiet, low liquidity during a week like Thanksgiving week. Obviously, the market's being closed today, Thursday, and we got a shortened day on Friday. However, right in line with how 2025 has been, the markets have been anything but quiet this entire week, as we have seen a massive recovery off some of the lows that we saw last week due to some of those AI valuation fears, Fed rate cut fears. I mean, the markets, folks, this week have been on a tear in a good way, and the bulls, I would venture to say, are very, very happy. So we're going to break down all that, but first of all, let's jump into Opendoor and see where we stand right now in one of 2025's most captivating stories in the market. So taking a look at the daily chart for Opendoor, we did close on Wednesday, basically flat. We were up 4 pennies, up 0.5%. You know, it was basically a nothing burger for Opendoor. But I think the more important thing to highlight with Opendoor that we've seen this week is the fact that we keep toying around with the $8 level. We have seen 3 attempts so far, Monday, Tuesday, and Wednesday, trying to get above the $8 price point. And even though we have been unable to do so, the fact that we have not had a massive sell-off shows me that, or, you know, I would venture to say what we're seeing here is just accumulation as we continue to make pushes towards that $8 price point. The fact that we didn't, you know, tap it and then sell off massively or anything like that, you know, makes me believe that we could see a break of the $8 price point here pretty soon. And, you know, as you can tell here, Monday, Tuesday, and Wednesday, we, you know, basically had 3 different tests of $8. Now, obviously, we're closed today for Thanksgiving, but come Friday on the shortened trading day, markets close at 1 p.m. Eastern on Friday. I would be very, very curious to see if Opendoor can finally get that break above $8 heading into the weekend. That would just be fantastic. And if we do a quick check-in on the RSI right now for Opendoor, we are sitting at 52 on the RSI. So we're basically kind of in this like neutral zone right now. Now on the daily chart, as far as some of the major moving averages, major Fibonacci levels, and where we stand right now, we have been very, very close to getting a close above the 50-day moving average, which is currently sitting at $7.83. We did not get that on Wednesday as we closed at $7.78, but we are right there. And so I would venture to say that we are very close to getting back above that 50-day moving average, and some of the overall bullish sentiment that we're seeing in the overall market, especially in small caps, off renewed hopes for the Federal Reserve to cut rates again in December, have definitely been helping Opendoor. So we are above the 38% Fibonacci level, which is 692. And we really saw something very similar over the past week in Opendoor that we saw post earnings. We basically had a run down to the 50% Fibonacci level of 570. And then we had a very hard bounce to the upside off of that level, which tells me there's a lot of buyers sitting just below $6. We obviously saw that happen back in early November post earnings on November 7th. And we saw the same thing play out again this week, starting on November 21st. In pre-market, we got all the way down to that 570 range, but we bounced up. And really since then, we've seen a nice recovery in Opendoor. And so right now, we're basically back where we had been as far as this channel between basically $7 and $8.50, right? This is a channel that really Opendoor has been in, I would argue, since early October. And now we are right back in the middle of that channel right now, just looking for a break, right? A break one way or another. But as of right now, I think we are in an accumulation phase on Opendoor. The volume was light on Wednesday, only 108 million shares transacted, which makes sense heading into Thanksgiving. So, that makes sense to me. But taking a look at the options chain for Opendoor and the action we had on Wednesday on, again, light trading volume, just under 200,000 contracts exchanged, but we are seeing a put to call ratio 0.30 on Opendoor. So we are seeing very, very bullish sentiments right now for Opendoor, as you can tell right here in the bottom right hand corner, put to call ratio 0.30. So that's great to see. I'm excited to see that, and definitely the sentiment remains bullish for Opendoor. So heading into Friday, it'll be very interesting to see if we can get above $8. I believe we can. I think the overall retail sentiment around Opendoor is still there. Nothing has changed negatively about the company when it comes to fundamentals. We got the warrants out now, and especially off the renewed hopes of a December rate cut, I would argue that's probably the biggest thing going for Opendoor right now that's really been a tailwind for the bulls. So we'll see how we can close out the week. Obviously, we're closed today being Thanksgiving. But Friday, tomorrow, markets are open till 1 p.m. So let's see on a shortened trading day if Opendoor can get above $8 heading into the weekend. That would definitely bring some over the weekend momentum, I believe. You get a lot of people talking about it as they see it starting to curl back up on the charts. Could be very interesting. All right, let's do a rundown of the Stonkcast Watchlist. So some other tickers and stocks that you need to be paying attention to. First of all, one we've been talking about for a while here. Just want to bring it up again for those who maybe didn't see the last episode we did. Lightbridge Corp. This is a company that is currently sitting at the 200-day moving average. Last time I talked about this, I said I want to see a bounce off that 200-day. And so far we are getting it, folks, getting a nice bounce. So this could be an excellent dip buy opportunity for anyone looking at Lightbridge, but this is definitely a company that I like for the long haul and could be setting up for a nice swing trade here. The RSI is currently sitting at 36. Over the past year, we've seen lows of 437 and highs recently of 31.34. So this thing can get moving and get moving quick. But this is an interesting company as far as what they do. For those who don't know, Lightbridge Corporation engages in research, development, and commercializing nuclear fuel. And we know how important, with the AI race, we know how important energy, clean energy is to President Trump and his administration. And so nuclear energy is something that has been on the table, talked about a lot. And so that's why I like Lightbridge here. All right. Quick check-in on Lemonade. This is a disruptor in the insurance space using AI, similar to how Opendoor is a disruptor in the real estate space using AI. And Lemonade, folks, I had the highs of 83.77. With the market weakness, it dropped all the way down to 65, and now it's curling back up again. It is above not only the 50, the 20, and also now the 5-day moving averages. It looks like it wants to break a new high. I love the setup here for a swing trade. This is definitely one to have on your radar, and another one that you could look at potentially investing for the long haul in. The market cap on this, despite the price point of being, 77 and change, the market cap is only like 4 or 5 billion. It's not that large. And then one that, I made a boatload of money on from 250 to 660 back when it initially ran in basically early October is Bitfarms. And folks, this is one that had a massive sell-off that's heavily tied to Bitcoin and how Bitcoin does. It's a Bitcoin miner, but this is a data center play, right? And so this is one, all that to say, that I am now back in on Wednesday. I sold I had some $5 calls on Opendoor expiring in January that are obviously in the money. So I trimmed those so I could take a Bitfarms position. I believe I bought the May monthly expiration. I bought $8 calls on Bitfarms. So I bought myself time on those. I got, 6-7 months of time on that. But I just love the setup here. We got back above the 5-day moving average. We basically have a floor at 250 that Bitfarms, defended, buyer stepped in, and we got a massive close above not only the 61% Fibonacci level on Wednesday, but also above the psychological level of $3. And we closed at 310. It was up nearly 12% on the day. And obviously Bitcoin finding a floor and curling back up is helping that as well. So considering the fact that this thing got a massive haircut off those 660 highs that it had back in early October, I definitely like, the setup here, the risk reward for another crack to the upside on this. So this is definitely one to have on your radar. We made a ton of money on this when we played in early October. So, the put to call ratio is 0.33, very bullish on the options chain for Bitfarms. So definitely one to keep tabs on. And speaking of data center plays, I found this post here on X from Daniel Romeo. AI is insatiable. All compute, every data center and every kilowatt will be used. Yet the market is dumping all data center plays. Look at this list of companies that are down from all-time highs. You got ticker symbol NBIS, Nebius, down 37% from all-time highs. You got Cypher down 43%, Wolf, APLD, you got CoreWeave, Bitfarms in here, 63% off all-time highs. GLXY, Iron, CLSK, Riot. These are the highest quality companies in the space, according to Daniel here in this post. And the market is acting as if the AI supercycle were close to ending. That will not happen as long as the race for artificial superintelligence continues, which is the most important technological event in human history. So this is an interesting post, and you might as well just write down all these names, comb through the charts, keep tabs on them, because these are all excellent plays if you're looking to have exposure to any of these data center plays. And he makes a very valid point here in this post. They're all just getting beat up. The market's acting as if this AI supercycle is over. And in reality, we're not even close to over. So, those are just some of the plays that I'm paying attention to. Make sure to drop a comment. Let me know what you're checking out. All right, let's move on to the major indices. First of all, let's do a quick check-in on the S&P 500 via the ETF SPY. And beautiful recovery that we have seen on SPY after having, basically a week below the 50-day moving average, which made all the bulls very nervous heading into the end of the year. And what a massive recovery we have seen in the S&P. Surprise, surprise, yet again, right? Buy the dip mentality worked out. Obviously, John Williams, the Fed president in New York, with his dovish comments, definitely helped, but nevertheless, we are now officially back above the 5, the 50, the 20-day moving averages on the S&P, which is great to see. We've had an excellent 4-day rally in the market, and really the last red day that we had was, that Thursday post NVIDIA earnings, where initially NVIDIA earnings were taken by the market in stride as really good on that Thursday. and we were up like 0.8%, and then the market just reversed and wiped it all out, and that's that massive red candle you see there. But since then, folks, we have been green, 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 green. So great to see, and not that far off yet again, all-time highs on SPY, which is 689.70. So I think we are setting up beautifully for an end-of-year rally now that we have basically digested whatever that was that we saw previous couple of weeks, those AI valuation fears, concerns about December rate cut not happening. We've digested all that. We've had some change of events as far as the rate cut probabilities, and now it seems like the end of year rally is back on the table. So love to see it. Also keep in mind that, as far as retail goes, anything discretionary, the retail space, the retail sector, this is the biggest time of the year. You got Black Friday coming up tomorrow. I heard something like 75% of all retail revenue is generated this weekend, this Black Friday weekend, Cyber Monday. So big weekend coming up for really an important piece of, the economy, important piece of the market. Think about the consumer. The consumer is a big piece of the S&P 500. So, and how, the consumers impact the stock market. So retail sales, things like that, we pay attention to because the consumer is such a big part of this U.S. economy. So very interesting time of the year. Market rally seems to be back on pace. And we do a quick check-in on the tech-heavy NASDAQ via the Qs. Same story here. Nice bounce off that 23% Fibonacci level, which we didn't quite touch on the S&P. But even more support here found for the Qs and back above major moving averages as well, not that far off all-time highs. And quick check-in on IWM, the small caps, folks, off the odds of a December rate cut going back up, looking fantastic as well. I mean, we saw some dips on IWM that look kind of scary below the 50, the 20, the 5-day, even going below the 23% Fibonacci level here, and looking like we might make a run at the 38%, all the way down at 221, but we did find a base at 279, and as of Wednesday's close, currently sitting at 247 and change, up 0.9%. You had the Qs up almost 0.9%, S&P up 0.7%. So great day on Wednesday. Market looks very strong heading into what is now Thanksgiving. Small caps getting a boost here. That's obviously helped, companies like Bitfarms and Opendoor. And the VIX is coming off massively, closed at 17, back below the 200-day moving average on the VIX as of Wednesday. So that's great to see as well. And quick check-in on Bitcoin at time of recording. So we bounced off of a major Fibonacci level here. This was the 50% Fibonacci retracement. This is based off of a 2-year Fibonacci chart, Fibonacci levels, right? Based off of November 2023 up till now. And we did tap that 50% retracement. And at time of recording, you got Bitcoin up 1%, sitting at 91,400, looking very, very healthy here. Want to see it get back above, this is basically the 38% Fibonacci level right here, right around 91,004, 91,005, basically. If we can get back above this, then we have a serious crack at the psychological level of 100K. This is TradingView for anyone interested in new trading software. Make sure to check them out. They're excellent. You can check the link in the description and get $15 off. All right. Let's move on to some macro news. So first of all, I want to take a look at this piece here from MarketWatch. Stock stage powerful comeback ahead of Thanksgiving. It wasn't enough to erase November's losses. So some key points here. U.S. stocks rallied for a fourth consecutive day, recovering all losses from the previous week ahead of the Thanksgiving holiday. The Dow Jones Industrial Average and S&P 500 each rose by almost 0.7% on Wednesday, with weekly gains of 2.6% and 3.2% respectively. Expectations for a Federal Reserve quarter-point rate cut in December increased to 85% from 30.1% a week prior. So that is massive, massive news, really, to me. The fact that the December rate cut odds were basically a coin flip at one point in time. Then, earlier this past week, there was as low as 30%, as this article lays out. And now we are sitting at 85%. That has just given the market a serious boost. Obviously, investors feel very good about that. And you can get an overall read on, what the market sentiment has been around rate cuts, right? You have, one camp saying we don't need to cut, another camp saying we do. But I mean, just look at how the market reacted when the Fed rate cut odds for December dipped below 50%. We saw a massive sell-off. The market did not like it. So, overall this week has been very impressive, the recovery that we're seeing in the market. And, basically heading into Friday, want to see us hold that 50-day moving average on the S&P. And then from there, see if we can take a crack at all-time highs. So as this article says, the market's latest gains came after the S&P 500 finished above its 50-day moving average on Tuesday and Wednesday, an encouraging sign that the near-term trend is likely to be higher. However, this week's powerful comeback was not enough to offset overall losses so far for the month of November. The S&P 500 was still off 0.4% for the month as of Wednesday's close, while the NASDAQ Composite was off by almost 2.2%. So historically, November is the second bullish month out of the year over the past 20 years of data. And so far, we're looking like if the month ended today, right, it would technically be a red November, which is rare over the past 20 years. But we still got time. We still got, another day, I guess, really, just Friday. Chances are we're not going to be able to clear that gap and actually finish the month green, but you never know in this market. That's for sure. As this article continues, meanwhile, expectations for the Fed's next quarter point rate cut in December jumped to 85% on Tuesday and Wednesday, up from 30.1% just a week ago. Expectations shifted after New York Fed President John Williams indicated last Friday that there is scope to cut interest rates in the near term. Fed Governor Christopher Waller followed on Monday by making the case for a December rate cut. So you got two Fed officials, one in particular that is very close to the Fed chair, Jerome Powell, which is John Williams, both with heavy dovish tones, and that has definitely helped the odds of a rate cut. So as far as that rate decision, that'll be December 10th. It'll be very interesting to see if we get a rate cut or not. Obviously, we're going to continue to get some economic data, but some of the data that maybe the Fed would want, they're not going to have till after the Fed decision on December 10th. So we'll see what happens there. All right, let's move on to this piece from Barron's. Google stock has been the clear AI winner, and the gains could keep coming. So Alphabet's stock gained almost 70% over the past 12 months, reaching a record high with half the gain from PE multiple expansion and half from earnings growth. Despite increased spending, Alphabet expanded third quarter pre-tax profit margins by 7% points and grew pre-tax profit by 39%. Alphabet's new Gemini 3 AI model, launched recently, includes tools like DeepThink and generative user interfaces, demonstrating its competitive AI position. So if anyone has been paying attention, Google has been on a tear. As far as the Magnificent Seven goes, Google in particular has been right at the top. I mean, if we just do a quick check-in on the 1-year chart for Google, it has been absolutely nuts. We saw a low back in April, right around the tariff lows there of 140 and change. And as of Wednesday's close, we're sitting at 319, almost 320 on Google. That is just absolutely insane to me. Just the run that we've seen. And here's the thing about Google. They had their hand, so to speak, in a lot of different things. Microsoft is kind of a one-trick pony. NVIDIA is kind of a one-trick pony when we talk about Magnificent Seven stocks, Magnificent Seven companies. Meanwhile, Alphabet, the parent company for Google, right? They do everything, it seems, right? And they just continue to add to the arsenal. So very, very interesting stuff here. And as this article lays out here in Barron's, For starters, Alphabet still isn't all that expensive. Even at 26 times earnings, as the second cheapest of the Magnificent Seven, with only Meta Platforms at 20 times, trading at a lower PE multiple. The comparison between the two is telling. Both are making gobs of money and both are spending lavishly on their AI capabilities. But whereas Meta isn't seeing much of a return just yet, its pre-tax profit margins fell 2 percentage points year over year, while capital spending more than doubled to almost $19 billion from around $8 billion. Alphabet has been getting more profitable. It grew third quarter pre-tax profit by 39% and expanded pre-tax profit margins by 7% points, even as it spent $24 billion, up from $13 billion a year earlier. So right now, Google is a very, very interesting Magnificent Seven company. And here's the thing. There used to be this old investing philosophy with the Dow where you would just simply buy whatever was the lowest priced or the most beaten up, undervalued in the Dow. And then you would sell it, a couple of years later when it would become, a bit frothy, and just rinse and repeat, buy what's at the bottom, right? And you could essentially apply the same thing to the Magnificent Seven, where you're just buying whatever is the best value, right? And so right now, despite the fact that it's at, all-time highs, Alphabet, folks, out of the Magnificent Seven looks like the best value right now, in my opinion, at least. Taking a look at this piece also from CNBC, we got some news this past week from Alphabet in particular, as this article lays out here. NVIDIA stock falls 4% on report Meta will use Google AI chips. So this is interesting. NVIDIA shares fell on Tuesday after the information reported that Meta is considering using chips designed by Google. Shares of NVIDIA fell as much as 7% before recovering to trade down 4.3% later in the day. Google parent Alphabet was 4.2% higher after a more than 6% rally on Monday. On Monday, the information reported that Meta is considering using Google's Tensor Processing Units, or TPUs, and its data centers in 2027. Meta may also rent TPUs from Google's cloud unit next year, the publication reported. Google Cloud is experiencing accelerating demand for both our custom TPUs and NVIDIA GPUs. We are committed to supporting both, as we have for years, a Google spokesperson told CNBC. And here's the thing, these TPUs for Google, they're nothing new. They've been around since 2018, but they've basically revamped them to have AI capabilities. And so, from an NVIDIA investor standpoint, this news of Google, partnering with Meta was not great. And now the question really becomes, can Google basically compete with NVIDIA as it comes to, the AI chip side of things? So this is very interesting news. And we just continue to see Google make appropriate moves to gain market share and step into this next phase of innovation, which is AI. So this is very, very interesting. And we've seen such a rally in Google over the past year here in 2025. Very excited to see where it goes in 2026. So, this is one I would personally be investing in. I like the partnership idea with Meta. I like the fact that they could be taking market share from NVIDIA. Granted, TPUs are not the same as GPUs, right? So it's a little different from what NVIDIA is doing. But when we talk about Google expanding into AI, that could easily take NVIDIA market share. And that's why we saw NVIDIA fall 4% earlier this week, I believe. So interesting stuff. All right. And this last piece here from MarketWatch, mortgage rates fall sharply on expectations of a Fed rate cut. Will they keep on dropping from here? So mortgage rates took a dive on Tuesday, pushing the 30-year rate to the lowest level in a month. The 30-year fixed rate mortgage dropped by 12 basis points to the lowest level since October 28, according to a daily survey by Mortgage News Daily. The 30-year was down to 6.2% as of November 25th. The 30-year mortgage averaged 6.93% on the same day a year ago. The decline in rates followed a drop in the 10-year Treasury note, which fell below 4% for the first time in almost a month after financial markets bet on the likelihood of future interest rate cuts by the Federal Reserve. mortgage rates don't directly follow the direction of the Fed's benchmark short-term interest rate. Instead, they tend to move in tandem with the yield on the 10-year Treasury note. After the delayed September jobs report delivered mixed signals, several Fed key officials hinted they would back another rate cut, despite some likely dissent on the committee. Jake Kreml, a senior economist at Realtor.com, said in a statement. So the fact that you're seeing mortgage rates begin to come off a little bit because the 10 years coming off is great news. The decline in mortgage rates followed, as the article said, the 10-year Treasury note falling below 4%. That is great to see, and directly impacts, mortgage rates, which is very helpful for Opendoor. If mortgage rates continue to come off, that is basically going to signal to people who either want to refinance or get into their first home or just buy a home, period. It's going to bring liquidity to, the industry, residential real estate, that is. And that is massive news for Opendoor. That's exactly what they need for their business to thrive. So just another macro piece, another macro sign that Opendoor might be positioning itself at the right time to basically, revamp their business as mortgage rates are coming off. Very interesting stuff here. All right, let's move on to the economic calendar. First of all, I want to take a look on this lightened, trading week with Thanksgiving and all. I want to take a look at some of the data that we did see so far this week. Initial jobless claims came out on Wednesday, and, they basically came in a little bit better than expected. We had a forecast there of 226,000, and we actually came in 216,000. So initial jobless claims, not as bad as expected. That's great to see. And then earlier in the week, we had PPI, which we talked about, this week being a big deal, basically came in line. And then we did get CPE data, which is the Fed's preferred inflation gauge, and that basically came in line as well. So as of right now, and this was another interesting piece as well, Tuesday, November 25th, we had pending home sales for October, which were good. They were up, so another sign that maybe residential real estate is starting to get unlocked a little bit. And on Thursday, today, right, being the holiday, we still got some data that will come out even though the markets won't be open. We're going to get new home sales data. This is for September, so, it's a bit delayed, of course, but still will be interesting to see what those new home sales numbers look like. And then Friday, we got the shortened trading day. We'll be closing the market at 1 p.m. Eastern, but we will get Chicago PMI for December coming out at 9:45 a.m. Eastern. So that's what we got as far as the economic calendar for this week. And, really, if we take a look at next week with the first full trading week of December and what we could be expecting there, you're going to get the JOLTS job openings for September. That'll be very interesting on Tuesday, December 2nd. PCE data coming out on December 5th. That'll be big as well. Again, the Fed's preferred inflation gauge there, personal consumption expenditure. So that's what we got. And then quick check-in on the earnings calendar towards the end of Q3 earnings here. Not a ton going on. Although we did get some interesting numbers that came out this week. You had Zoom, which reported on Monday, and they beat on top line and bottom line. So that was interesting. You had Alibaba. They had a pretty nice beat on their EPS of 24%. You had Dell report on Tuesday as well. Miss on revenue, slight miss on revenue, but they did beat on the bottom line EPS. So interesting stuff there. And then you had John Deere on Wednesday with a massive revenue beat of 25% based off what the street estimate was. No earnings, of course, today with it being Thanksgiving, markets being closed, and no earnings on Friday either. So that's what we got, folks, for the midweek check-in on this special holiday episode, this Thanksgiving episode. I hope, again, everyone is enjoying their break time with family and friends. I hope you're eating a ton of food, watching your favorite sports. A lot of good football on today and really just this entire weekend. So very excited for a chance to kind of kick back with the family, as I hope you are as well. Appreciate all the support as always. Make sure to drop a comment. Let me know what you think about the Stonkcast Watchlist, Bitfarms, where it might be going, Opendoor, where that might be headed, and what you think about whether or not we're going to get a December rate cut on December 10th. I will be back, as always, for the Market Prep episode on Sunday, 7 p.m. Eastern sharp. Appreciate all the support. Don't forget to like, share with a buddy. Don't forget to follow us wherever you listen to podcasts. And folks, as always, remember, plan the trade and trade the plan. Have a good one.